was having a conversation with one of our clients the other day who was contacted by another hard money lender. And my first thought was, hey, something that Brad and I preach about all the time. Talk to as many lenders as you possibly can so you can feel comfortable working with that particular company. The second part I thought was, we did this client's first deal with them, and now they've done so many deals that they're effectively being headhunted by other lenders. I think that's pretty amazing. And I actually told the client that. I said, think about where you've come in the last 2 years. So those were two things that came to mind immediately. But what they brought up to me was a very interesting loan structure that that lender was offering them. And it made me think, maybe we should make a video about how do we digest and really understand the different loan structures that are being marketed out there. So what I wanted to talk about today is, how do you compare a 65 to 70% ARV loan with a loan that, let's say, is based off of the purchase price and funds the rehab, and kind of take a really good look at what is being marketed. And what you'll come to find is most lenders are gonna hover around the same loan amount. So whether I'm gonna be at 65% ARV or I'm gonna lend to you 80% of the purchase and 100% of the rehab, as a borrower, what you wanna do is use specifics with that particular lender. What does that mean to me on this deal? What are you seeing the after repaired value for on my transaction, and what does that result as a loan amount? And I can compare that to 80% of the purchase and 100% of the rehab, or whatever the numbers may lie. So the second part that I wanted to also talk about is, if it sounds too good to be true on the front end, chances are it is. So here's what this client talked to me about. This lender contacted them saying they're gonna lend 100% of the purchase and 100% of the rehab. Hold on one second. That's 100% of the deal, right? Yeah. Well, that sounds a little bit too good to be true to me. So that client kept going back and forth over a series of hours and days with that particular investor and that particular company, and was like, well, what's the catch? Always ask what the catch is. Well, it turns out that if you wanted that loan structure, your total loan amount, 100% of the purchase and 100% of the rehab, had to come in at less than 50% of the ARV. What? In California, that's not really gonna happen unless you're doing a ground-up construction deal, and I would argue still, that's gonna be difficult to find. So in the fine print there, it's a little bit of a bait and switch. It's a little bit of it's too good to be true, and it's just kinda something that kind of puts my little sniff test on to say, if they're gonna get me in the door this way, I'm not really sure if that's who I wanna work with. But those are the reasons why you ask those questions. What's the loan amount on my deal? What are the parameters outside of what you're telling me? Example, 65 to 70% ARV. Are there any purchase price parameters? Will you go above 100%? Will you go up to a certain percentage of the purchase price and cap out there? Ask these little questions that are specific to your deal so you understand what people are really offering, and then you can compare lender A, B, and C, and oftentimes you'll find there's a different deal that fits each criteria. So have multiple lenders to call on who you feel comfortable working with, and that you can understand what they're offering you.